Thanks for tuning in. Today's guest is Luke Johnson. He is the co-owner of Healthcare Finance Direct and HFD for short. And they effectively provide buy now, pay later payment solutions for healthcare companies, specifically in dental. We talked about the market distribution, why what they're doing is unique and much different than Klarna or any of the other buy now, pay later products that are out there. We dove deep into healthcare, the structure of the healthcare system in the United States, how it could potentially be reframed or reshaped, the problems with it, at least as we saw them. This is one of these businesses that have been around for a long, long time, and they have a huge advantage to the data that they've accumulated over the years. And we talked about why data accumulation is so important in this business, as well as others. So here is Luke Johnson. I hope you enjoy. All right, Luke, we are live. I'm excited to chat with you. Why don't we kick it off? Tell me more about what you're working on and how you got into it, specifically healthcare and the company.
Sure. Yeah. So our company name is Healthcare Finance Direct. That's a mouthful. As Chief Marketing Officer, I often get a request to have it shortened. But what do you think about that?
I like the acronym HFD.
Actually, we've had a lot of people. Hey, why don't you just go by HFD? I've heard that 6 or 7 times. But so we're a buy now, pay later company in the elective healthcare space. And I mean, buy now, pay later fits directly into the fintech sector. So that's why I'm here talking to you. But our main niche is that we approve 100% of patients. Now, consumer BNPL they focus primarily on the prime credit consumer. And so HFD specifically, I'm gonna refer to myself as HFD from now on since you said that. But HFD, after approving 100% of patients, that really sets us apart, and everyone's basically asking, how in the heck is that even possible? That doesn't make any sense relative to the standard, lending model and risk mitigation techniques that have been put in place since the 80s in healthcare. So that's our main niche, is 100% approval in the elective healthcare market.
So an example of this would be somebody walks in to buy an optometrist, they're going to an eye doctor, and they're buying a checkup and a pair of glasses, prescription glasses. Is this the kind of thing they would pay using HFD? Or is it?
Good question. So the easiest way to explain it is through one of our customers that most people know, and they're Smile Direct Club. So Smile Direct Club sells invisible aligners, through their difference is that they sell it through teledentistry, an online model, instead of through brick and mortar dental practices. And HFD, we actually power their pay over time options. So when you go into Smile Direct Club, they have 2 options: pay in full or pay over X amount of months with a $250 down payment. I'm not sure if that's the down payment that they have today, but if you choose to pay over time for 24 to 30 months, whatever it is, then it's sent to Healthcare Finance Direct. And we're the ones that will originate an installment contract so that the patient can pay over time. And we collect an interest depending on what plan is chosen. We have 0% APR products as well. And then we actually charge the payment on a monthly basis. And no collection companies, nothing like that. It's a much better user experience. So that's kind of the typical flow that I tend to reference. But we're in all elective, so dental, cosmetics, audiology, ophthalmology. Those are our main ones, and we're growing like crazy. So we'll probably be moving into other markets as well.
Got it. And so basically the core concept of the business model is to allow people to spread the payment for elective medical procedures or just elective services over time in exchange paying interest. So it's effectively like a micro loan. Instead of taking out a mortgage for a house, you could take out a $500 loan paying incrementally over time to HFD. So HFD would be the lender, and then you make money on the interest you generate from those purchases, those loans. Is that the right way to think about it?
Yes, that's the right way to think about it. But there's definitely some differences relative to how, the audience may compare us. So again, if we're talking about Affirm or Klarna or any of those direct to consumer buy now, pay later companies, the main difference between us and them is they focus on the prime credit consumer. So they're approving, let's say 30 to 40% of people that apply. And they'll do, 6-week microloans, 2-month, 3-month, 4-month, sometimes 6-month, but we'll go all the way to 84 months. We'll go 6 weeks all the way to, 84 months. And yeah, that's the main thing. But the backbone of it is, like you're 100% correct, is that it shares the fixed repayment schedule trait that a standard buy now, pay later company would have, or technically a lender as well. So,
and why would, kind of two questions of one, why would Klarna and Affirm have such low approval ratings? They're only accepting 30 to 40% of the people who want to make payments through them.
Yeah, great question. That's how it's been for, since the standard lending model since it started, really. But the additional component there is, what they're actually, like what the actual asset is or what the service is that the consumer is purchasing. So since we're in healthcare, we're financing essentially a dental procedure or an aligner or, some sort of hair restoration. It's a service that greatly improves the patient's quality of life. And so you have this urge, not just from HFD, but from these healthcare providers that want to treat every patient. So taking a step back, Care Credit, who is, they're the major lender in healthcare. They have been since they started in the 80s. They've been approving around 40 to 50% and 40 to 60% in dental. And what happened when they launched that product, when they launched that company, was it was an amazing benefit to all the healthcare providers out there, but it also caused a big problem. What am I going to do with all those other patients that I now have to say no to? I mean, they were saying no to the other half before. But basically what ended up happening was a lot of healthcare providers said, I'm going to say yes, and I'm going to hire some people, put them in my back office, and have them call and collect payments. I'm still going to say yes to this person. I'm going to take the risk because I care about them and they care about me. And HFD essentially fills that gap to where it's like, yeah, healthcare provider, you get to say yes because I know you want to, but let's share with that risk together. Let's create a great experience for the patient, which we know that they can't provide unless they have, a lot of money to invest. And that was the main problem. So it started off with Care Credit in the healthcare space. Now touching back to Affirm and Klarna, it's just the same thing, but you don't have that healthcare spin on it.
Got it. And the approval rating for what was the company called? Care Direct?
Care Credit. These guys have been around
for a long time, relatively low. I mean, I think of 50% as being pretty low. If I'm going to make a transaction and 50% of the time I'm getting rejected, I mean, categorically that feels, maybe it's not compared to Klarna and Affirm. And I imagine the relationship the healthcare providers have to the people, they're making this subjective decision. They're saying, okay, I've seen Lindsay a number of times. I really got to know her. I really trust her. I understand her story. I know why she's not getting approved. She got into an accident, whatever the story is. And because I have this effectively this data point, you call it a like subjective data point that the lending company just doesn't have, I'm willing to take this person on. I imagine that the same can be true for people that the healthcare provider doesn't want to take on. They look at someone, they have a bad interaction with someone, they're probably going to say, hey, this is the option for lending if you want to go that route. Otherwise, like, sorry. Is that roughly the way to think about it? Is that healthcare providers would have another access or data point subjectively, and so that where they're willing to take on the effectively like the underwriting risk? Maybe they wouldn't say it that way, but
yes. So one of the major benefits that any healthcare provider gets when they work with us is the underwriting data and the performance data that we've been able to collect since 2009. So mom and pop shop in Ohio, they get the benefit of millions and millions of records of, dental patient performance data that they would have never had. But that's one component of it. There's also the actual experience, that the patient, if the mom and pop shop was to actually take the risk on themselves, and let's say they even had a decent infrastructure in place, it's not going to rival that of an Affirm, or this Silicon Valley company that will send you text messages or emails reminding you that your payment's going to be automatically processed on the day of your monthly scheduled payment. So there's the performance data, and then there's the patient experience that really sets them apart. And what ends up happening is the patients trust them, the healthcare provider, a lot more. And so case acceptance drastically increases, which is one of the metrics that every healthcare provider is trying to optimize for.
Interesting. And so when you, in the position of the company, like HFD, when you think about the incentives, do you think about it as more filtering out people who are higher risk, as opposed to like finding it's kind of like a pass or fail, right? You either, if you're above the line and you pass, well, it doesn't really matter. You're just going to get the same interest rate and loan as everyone else did. So it's more about finding the people who are higher risk. And kind of in lieu with that question is, what's the source of data? Is it, certainly you can aggregate your own data you're collecting, but I imagine the vast majority of the valuable data would be on credit bureaus or scraped from some, like, where does it originate? Like how does even Klarna and Affirm, where do they get the data to make the decisions?
So touching on the first part of your statement, HFD prices to say yes. And that is the fundamental difference from us and anyone else, right? Anyone that's backed by a standard big bank, the bank is in it to make sure that they don't lose, right? That's their primary objective. And since we don't have a standard, bank backed model, and we could talk about that more. What we do is we will actually price every single credit tier, and using like a standard FICO model, we will price every single credit tier with terms to say yes to them, not to filter out any bad consumer. They're all going to get a yes. It's just what's the interest rate, what's the down payment, and what's the term length. So that's a really big shift in the industry altogether, right? That's not. No one is doing that, though the approval rates are starting to increase, especially in healthcare. But all those other companies don't have 2022 already, 13 years of performance data. So touching on the data now, getting to that part of the question, we'll underwrite with standard credit bureaus out of the gate to establish a FICO range with for the patient. But the data that I'm actually talking about is we are the ones that are servicing these loans, these installment contracts, all the way till its maturity, till they pay it off. And so we have our own loss rate information, data on, 700 FICO or 650 FICOs in California versus 650 FICOs in Florida. And we were able to make that assessment and refactor our assumptions in our models. So it's pretty beautiful, especially when you start to work with some of these large dental support organizations. That's definitely one of the trends we'll want to talk about. These large DSOs, they have an actual finance team, that know what they're talking about, know how to mitigate risk, and know how to create, good financing programs. And when we partner with them with all of our data, and then they have all of their data, then it's a very compelling offer to the capital markets, to the investors out there. It's like, hey, we already know what it's going to look like, and here's how the math's going to work. Let's talk about it. And so then, people start lining up, seeing how they could be a part of it.
Got it. Okay. So originally I was thinking that the data you're referring to was on the individual level, but it's really the aggregate level where you can effectively predict based on the say FICO score or other pieces of correlated data you're pulling. And then you could kind of cross-reference them and say, you're living in Northern California, this FICO score, I don't know, this is how old you are, this is what your income is. And because you've had statistically significant data points since 2009, you can say with some degree of accuracy, with a high degree of accuracy, what the likelihood of that person paying back the loan. So I always think of it as like insurance, for instance, is unpredictable on an individual level relatively, but extremely predictable on the aggregate level. Is that kind of that's how you think of it? Yeah.
Absolutely. Yep. And we've been operating in all 50 states for, like I said, over a decade. So we're able to aggregate all of that data and come up with some really, really sophisticated risk modeling. And that's definitely one of the fun parts of the job for sure, because you get to talk to all these different finance companies across the country and talk to them about what they're seeing relative to what we've been seeing, especially, going into the macro economy that we're in now. HFD's already actually lived through the recession after 2009, and then also through COVID. So this will be potentially the third big milestone here. And the beauty, I don't want to say it that way. The interesting part is that the bigger or the standard consumer BNPL that focuses on prime consumers, as soon as you start getting out of prime consumers, it gets very, like, the model breaks, right?
What is BNPL?
Buy now, pay later.
Okay,
I apologize. Buy now, pay later. It's effectively the same benefits of a credit card, but it's a fixed repayment schedule right off of the bat. So that it's going to, right up front, it's going to be a 3-month repayment, whether that's 2 weeks or every 2 weeks or every single month. And then it's typically a 0% APR. So if I wanted to buy a nice pair of new Nikes for $400, then do I want to cough up the $400 now, or do I want to just pay $100 every month for 4 months with a 0% interest? I feel like I'm missing a key part there. If there's no interest, what's the model? Great question. Yeah. So when there is no APR, that's the backbone of a credit card, right? The discount is where the BNPL company actually makes the money. So it's the actual merchant, the person that's selling the good. So if it's in the situation I just explained, it would be Nike that's paying, let's say, a 5% discount on the $400 ticket. So now they're going to pay whatever that is. Let's just say $380. They're going to pay $380. I'm sorry, they're going to pay $20 to the BNPL company.
It's a competitor to the credit card. So if it's just another gateway of payment, competing with the credit card fees that credit cards charge, that makes perfect sense. Okay, so there's how you can fund the 0%. I want to ask you this: when why don't more companies, either buy now, pay later, or just generally lending companies, why do they say no so often? In other words, why don't they have interest rates that are just correlated to the risk profile of the individual? Instead of saying no, you say, okay, you're higher risk, so we're going to charge more. Is there some calculation that just says this person just, is there some law against it, or what's the philosophy?
Yeah, so there's definitely some laws that are at play here. I mean, Healthcare Finance Direct utilizes a retail installment contract, which is regulated by the RISA laws, Retail Installment Sales Act. It's not a typical lending company where you're regulated like you would be a bank, So there is that, and one of the benefits of that is that we can actually utilize a credit card, whereas a lender can't utilize a credit card. You can't pay a credit with a credit, and so that's one big benefit that we were able to utilize. But with a bank, they're utilizing everyone else's money, and so their primary objective is to not lose, and they're not. They're not creative, and they're not paid to be creative, right? They're paid to be safe. They're paid to get a very steady return. They're paid to not lose your money. And so when you have these very creative Silicon Valley companies that come up with a great model, but it's backed by a very rigid bank, then there's a clash there, And so that's why, so touching on it now, that's why we've created our flexible capital model. And we kind of recognize that, all of our competitors, they were all lining up with banks, and we were like, oh man, we gotta do that as well. But then we realized, well, we lose the flexibility that we've had this entire, last decade. And we see that as, tremendously valuable. And what we've done instead is, lined up an array of, private equity that allows us to create these financial programs with others, with our clients, and pitch it to this our group of partners. And then if one doesn't like it, we'll move on to the other. And if the deal's big enough, you could always utilize the bank again on the back end for leverage. So it's a beautiful model. It's definitely different fundamentally, though, on the capital side than what everyone else is doing.
Yeah, I'm curious to ask more about that. So on the capital side, so just to paint the high level again, you're getting money from somewhere, and then you're using that money to fund loans. And the core value offering that HFD or just the buy now, pay later companies do is they both provide the mechanics, like literally the software or the vehicle through which individual consumers or people can get these loans. And then you're deciding who gets them and for how much. So I think talking about where buy now, pay later companies get money, the banks are an option, but you said that comes at a cost of effectively conservancy. They're very conservative minded. They won't take on higher risk. So you're limited there. You could have like the credit markets, private equity. These are people who are raising money generally from individually wealthy people through LPs, and then they're putting it in. I mean, PE must vary significantly, but it's higher risk than a bank, lower risk than, maybe early stage venture capital. How do you describe this? I don't know if you've had access to, or this is part of what you touch on, but what does this landscape look like? How do people get connected? What's like a typical structure? I'm curious to learn more about that.
Sure. So it is a bit riskier than just approving prime credit consumers. So that's without a doubt. That's the elephant in the room. So might as well talk about it. But with that said, when you have so much data, data is the king. It's what is the old saying? Is he with the data he with the money maketh the rules. And now we say she with the data maketh the rules. And that's kind of our tagline. here. And it's riskier, but when you have hundreds of thousands of records, you know, and you say, hey, I've already been collecting for the last, 5 years. This is what's going to happen. And if you have any other concerns, you know, like the macroeconomy will discount it. It's not as risky as a bank would try to, explain. So that's one thing. A typical structure, we deal specifically with enterprise customers. That's our focus. We haven't really done this, standard practice level ever. That's never been our focus. And we do that because we love building custom programs with finance people, and the bigger shops are the ones that have the finance knowledge and the people on staff that are willing to think through those lenses. And the reason that matters is the discounts, the lower the consumer is on the credit spectrum, the discount's going to be higher, right? You're not going to pay a 5% discount on someone with a 0 FICO score. You know what I mean? That's not going to happen. But if you're able to market $79 a month to your entire, total addressable audience, then miracles happen. And finance people at large dental companies truly see that. They're like, wow, so you're telling me that I can actually put $79 a month for 20 months and market that to everyone because I'm approving all of them, right? That's the key. It doesn't have to be as low as type thing in the same situation that someone like a firm would have to do. So we get to have fun in that. In that way, we get to say, listen, this is the power. If you really lean into it, yes, you're going to have to take a bigger discount for the lower performing consumers. But if you truly lean into that, then your case acceptance is going to dramatically increase, and you're going to see that your total volume of patients treated is going to dramatically increase. The total amount of patients walking through the door, asking for services, choosing you when they're Googling you, that's going to increase because of the fact they're able to market in a way that you've never marketed before. And Smile Direct Club's been doing that for a long time, right? They're brilliant when it comes to marketing. And I think everyone's figuring that out, that marketing a monthly payment instead of just marketing care is very valuable. Yeah. So I'm not sure if I answered that exactly.
No, I think of it as, tell me if this is the right way to think about it, is that typically this buy now, pay later would assess the individual and then make kind of custom or semi-custom either pass fail, or if you do pass, maybe slight variances in the interest rates that you pay. Whereas the model you're describing is everyone's the same, everyone's accepted, and the prices bake in the people who default. So we know that, 10% of people, X% of people default. They only pay 3 out of the 10 payments, whatever the number is. There's a loss that's going to be there, but you factor that into the price. So for better or for worse, that's people would pay more, and knowing that they're effectively carrying the load for those who don't. But it's also simpler, and then the companies, the healthcare companies, can market like a more simple pricing model. Is that roughly right?
Yes, it's right. Yeah. It's basically, the answer to that is it's both. So if you go into our website today, there's not going to be like a standard rack rate pricing that you're going to see. And that's by design. It's we know patient financing better than anyone. We're willing to build, as long as the math works, relative to our data and yours, we're willing to build it however you want to build it, right? And so if they want, the first example you gave, then we're willing to build that and figure that out and make sure that it's the best for them and their patients and capital partners. But if it's the latter, then we're happy to do that as well. It's not a one size fits all. It's not a Yeah. So that's the best way that I could say that.
I want to ask you about this. This is another thing I wonder about. People who don't pay the loan, say you have, 10 payments of $79.99, you're on payment 3 and you just stop and you just ghost, like, no, the text messages come in, calls come in, I changed my number. Is there any, like, what happens from there? What's maybe the way that these healthcare companies were doing is they were trying to manage it clearly. They're not going to be as efficient as a company who is dedicated to doing this, like healthcare, like HFD. I imagine the limits to what you can do are set by the law. Is that right? Like, you can't hire someone or you can't knock on the door. Like, what can you do? What can't you do? What practically is effective?
For sure. So one thing to note here is that a lot of patient financing or just financing companies in general kind of focus on originating a new loan or a new installment. And once they do that, then they hand it off to another company that does all of the servicing and collecting of payments and whatnot. And we don't do that, and we don't do it for a reason. We want to make sure that the patient experience for the patient is great all the way through. Not just for someone who makes their payments on time, but also someone that doesn't, that defaults. So that's just stopping there for a second. That is extremely valuable to the healthcare provider who's been seeing that same patient for 10 years or that family for 50 years. It truly matters to them. And so we deploy white labeling technology so that the logo of the healthcare provider that the patient saw when they walked in and received treatment, that's going to be present, and those colors and fonts and whatnot are going to be present all the way through the servicing of their installments. That's a big thing, right? Because they just feel a sense of comfort. But additionally, that actually helps when you're collecting payments, because they actually prioritize those payments more because they feel like they owe. Obviously, they owe a debt, but they're connected at that personal level in a way that they wouldn't ever be with a Nike or someone that's outside of healthcare. But getting to specifically what you stated, we text them, we email them, and we call them, and we have a very specific delinquent account servicing policy that is regulated by a few different laws that I can't remember the names of, but don't worry, we have someone that knows the names of those. But the texts, the emails, the calls, without a doubt, are not the spam style.
Yeah.
They feel like you're actually talking to someone behind there. And I'll say when you call HFD, we hold ourselves to a 10-second average speed of answer rate. ASA, and that's it basically means you're not going to call us and wait like you are.
When someone wants to give you money, you pick up the phone. Yeah,
exactly.
That makes total sense.
10 seconds is pretty good.
So yeah, text, call, email, and I assume this is just, let's speak more broadly about the industry, right? Because you're not unique here. Yeah. I don't think you can pick up the phone fast, you can send nice text messages, but effectively everyone's doing the same thing. I think, and that's what I was kind of curious about, is like, you can't send anyone to the house. You can't, what can you do? Do you file this with the government, or you send a report to like Equifax and say, hey, this person gave up and stopped paying and we want to damage their credit? Like, do you know how that piece of it works?
Yeah, so we do not ourselves, like our default is that we do not damage anyone's credit even when they don't pay. And that's due to the fact that the healthcare provider doesn't want that, right? Oh, it's is the
healthcare provider's decision, or it's just kind of across the board?
Well, they're our ultimate customer. So yes, it is, but when they're selling this installment contract to the capital partner, it's technically their decision, but the terms are agreed upon prior to. So yeah, it is the healthcare provider's decision at the beginning. But basically what I'm saying is, like, in healthcare, they don't want to send their patients to collections. They just don't, but they want to collect the money. And so what's the best route in order to, you know, collect all the payments or as much as possible without ruining the experience, or damaging their relationship with the patient. So, yep, we don't send that. We also don't charge or do a hard credit pull when we originate the installment contract. So that's another big difference. So anyone that goes through a standard lender is going to get a hard pull, and it's going to affect their credit. And we never do that.
Yeah. Yeah. So I imagine that must vary, right? Like some companies would send it to the, like, what's the advantage of doing that? Send it to the credit bureau. Like, take, for instance, I get a car loan, right? It's like a $50,000 car loan. I stop paying it after $5,000. Wells Fargo is going to report that to, right? Because, and what's their incentive to do that? I mean, do they get paid somehow, or get any kind of repercussion money, or are they just doing it as, they do. Okay.
Yeah. They absolutely do. It's just abysmal what they actually end up collecting. You know? So, I mean, on a per payment collected, a collection agency is like, will take like 25 to 50% of what they collect, something huge like that. Whereas HFD's 4%. So it's not even close to the same thing. But I mean, I think it's also typically they want to do that because they just want a punishment to, you know, shape consumer behavior. But in this situation, we're typically doing services or custom products, like an aligner that's, you know, it's not going to fit anyone else. You can't steal an aligner; it's not going to do you any good. Yeah. So it doesn't really matter to go and take the aligner from you if you're not paying either. Yeah,
I imagine people fall in like different buckets, where you have people who literally thought they could pay, but they can't. They lost their job or whatever, something happened. Then you have people who are on the edge. They're like, that'd be so inconvenient to pay. I don't really want to. I'd rather buy this TV. And then you have people who are like, have plenty of money, and they're like, I'm just going to ignore it. Like, ignore the problem, because it is kind of unique in that healthcare I feel like healthcare, more so than any other like industry I can think of, is like, maybe on a small scale, you could see this as like restaurants, but you're in person. So it's obviously different. But you're receiving the value before you're paying for it. Like, I go to a restaurant, I ate the food, and then I pay at the very end. But you're in person, so like the chances that you get up and leave are like very, very rare. But it like healthcare is like, hey, we're going to perform this service, and we're going to sometimes not even collect money. We're like bills in the mail. And I think that concept of like bills in the mail means there's a separation between when I receive the value and when I pay for the value. And that has to negatively correlate to people paying. Because like 3 weeks after I got, you know, a cast on my arm, I'm like, well, you know, I don't even think it wasn't my fault. Didn't need the cast. What are they going to do about it? People come up with these rationalizations. So I don't know. I don't know what the answer is, but that's kind of how I think of the psychology of people. Does that resonate and seem? Yeah.
Absolutely. Yeah, without a doubt. I mean, we see different performance across elective verticals for sure. So, I mean, cosmetic is much different risk than dental, which is much different risk than LASIK surgery.
Are those higher? You know? LASIK is higher than dental is higher than...
LASIK, for instance, is an older demographic. So you're going to get better payers. Right. So, So, I mean, cosmetic is better than dental. Dental's typically kind of lower, but it's also the largest market by far.
Really?
Like it's dental? It's $130 billion as of 2018. So I think there's a 3 to 5% growth rate. So it's booming, and just putting that in perspective, cosmetic is, I think, around 16 billion. All ophthalmology is like
Wow.
1 billion.
Wow. So dental really,
and I might have those off,
yeah,
slightly, but just to put it in perspective for you.
yeah. So really, the story there is dental is by far the largest part of the elective healthcare market. Is that because of the way that insurance is structured, whereas most healthcare insurance companies don't incorporate dental, and therefore there's a lot of independently operated dental facilities?
Absolutely. But I mean, same with LASIK, right? I mean, the LASIK is typically not covered, and it started out as like $10,000 an eye. And so now it's down to like $2,000 an eye. So coverage is definitely part of it, but you're also seeing that there's just the capitalist structure is definitely bringing down costs in a way, but the fact that, deductibles and everything are still playing a part, it's definitely, I think it's just a bigger market, right? Everyone has issues with their teeth at some point or another. Cosmetic, yes, but a lot of people tend to deprioritize that relative to you having an issue with a crown.
Yeah, and LASIK, you typically get one and done. I mean, I got LASIK surgery, and I went in there once for the consult, once for the procedure, and I think one more time. I mean, it might have only been 2 times. And it's like, I can see, I had like pretty shitty vision for a while. I had wearing glasses, and I go in, they shoot this laser in my eye, and I could see, and it's like, it's gotta be one of, if not the most amazing invention of,
so crazy.
Yeah, it's insane. But there's
honestly, I haven't done it, and I'm nervous. I'm blessed with good vision, but I know at some point I'm going to have to get the laser in the eye when I get older. I'm not looking forward to it, but was it all right?
It was so great. It was like, I went to this place in LA, and it was like super, super smooth. I mean, no pain. Like it's a strange process. Like, don't get me wrong. It's like you're lying down, it's this massive machine, and it's going to shoot lasers in your eyes, but it's not painful. It's and the thing that they go through, like the variability on the procedure is so low. It's not like, oh, this might fuck up. Like, it's not, the complication rate is really low. So that was ultimately,
got it.
Like, my emotions are deeply tied to the risk analysis, and it's like, well, they're like, we done 9,000 of these and had 2 issues. You're like, it's fine.
Yeah, I'm like just picturing that, like I sneeze and like the laser just cuts off my eyelid. Yeah, that's just where my mind goes. But yeah, I don't think that happens. So I think I think I'm overthinking it.
Yeah, I mean, I tend to think that this is the kind of innovation we see when there is a direct relationship between the person paying for the service and the person receiving the value. It's like the farther those separate away, then the slower things move, the more bureaucratic they operate. It's like, it's hard. It's like a game of Telegram where you're just, I have to tell my employer what insurance I want. And the insurance company goes and they tell the hospital and they tell the doctor's group and the doctor's group. It's like you're playing this roundabout, which I imagine dental is kind of mostly free market with some private dental plans. Is that the structure of the dental market?
Yeah, there's a lot of really good private dental plan companies that are booming right now. Membership plans. There's a company called Membercy that I saw at one of the last trade shows, and they're doing some awesome things. But yeah, just in the absence of insurance coverage, there's a lot of free market movement, and then a lot of ingenuity. And I mean, that's at the heart of what we're doing. That's, it's just free market capitalism. We're trying to figure out how to approve every single patient in a way that's profitable for the healthcare provider and the capital partner. And, it gets the patient what they need. So if we just had healthcare that was paid by the government, then, none of this would be taking place.
Yeah, totally. And you're even restricted by the laws, right? Like maybe, and not to even imply that they're, that they've reached too far, or to say that laws aren't useful at all. But you certainly could see how they could go too far. Imagine the law was like, you can't contact any customers via SMS, or you can't call anyone. You have to get opt-in to call, or whatever it is on the debt collection side, you could see how overreaching government could be a downside. Or in healthcare, I tend to feel that the regulation we have on healthcare insurance is counterproductive, to say the least. Like requiring employers to get healthcare then creates this system of, it's a relic from World War II in 1942. It's like a post World War inflationary mechanism to cap inflation. I don't know if you know this story. It's like it completely shifted my philosophical view on how I see healthcare. When people say healthcare, they say like universal single payer healthcare. They think in their heads healthcare insurance, like the mechanism for paying for it. And I think it's so important to separate those two, like seeing seeing the insurance part as separate from the value delivery mechanism. Like you go to the hospital, you see a doctor, and then separately you pay for it. But those two things, they're entangled in different ways.
Yeah, absolutely. I mean, the cost of to the provider is what needs to be the focus, right? I mean, the fact that a Lasik provider is able to offer $2,000 an eye or whatever it is because their costs as a business have decreased so rapidly within the last 10 years or whatever it's been. And that's where the focus needs to be, right? Is how can we actually produce the same output with less input? And ultimately that will translate over to the end consumer. So yeah, I mean, the dental market, the elective medicine market is just full of ingenuity. You should see some of the AI that's going on inside of dental. I know that might be a topic that your viewers would absolutely love, but there's some awesome companies that are doing some great things. I mean, I'm
just generally so bullish on the free market's ability to solve problems. What's your view on, the piece of the healthcare market that is not electorate or electoral, elective, sorry, thank you, is huge, right? It's like the vast majority. It must be like 99%. I don't know the number, but most of the money flows through employers to health insurance companies, through Medicare, Medicaid. Like it's, trillions of dollars. I think Medicare is 680 billion, roughly the same size for employer funded health insurance companies. Do you have a view on how we should restructure this? It's one of the, it's something that people are throwing around, different ideas, like whether it should be centralized, the government should manage it under a single payer. Canada, our neighbors to the north, have a policy or a structure where the government does centralize all the funds that are distributed for healthcare. As a repercussion, things take a long time, and there's negative sides, there's upsides, but I'm curious to throw that to you if you have insight.
Yeah. So just for perspective, some of the largest customers that we work with that have thousands of practices across the country, their portfolio size, though massive relative to any other entity inside of the dental market, it's about the same size as a local hospital. That's how much thousands of practices equate to one local, hospital in Bakersfield, California. It's way, way more money there. And it's definitely a complicated topic, but I think one of the first ways to start is to make it easier to pay. When we were talking to the hospital here in Bakersfield, they shared some data with us, and they were basically saying that patient responsibility, what the patient owes them after they get some sort of service or something taken care of at the hospital, they are only able to collect 1 to 2% of that. Think about that. 1 to 2% of patient responsibility that is owed to them. no wonder it's so expensive, right? And I mean, I'm just going to attribute that when you're hammer, everything's a nail, right? So I get that. I get that that I may have that that take, but having my daughter recently at the hospital, like they're still sending out paper mail, making you fill in your card information on paper and sending it over. They call you one time. It's just it's a god awful experience when you're comparing that to the Nike example where you're just paying for a $400 pair of shoes. Like Nike's getting repaid much faster than when you had a emergency surgery, and those typically are much more expensive, but it's like, why are they much more expensive? If you are only collecting 1% to 2% of patient responsibility, they're obviously going to have mechanisms in place to account for the fact that they're only going to collect 1% to 2%. Mm-hmm. So figure out how to lower the costs to the hospital. That should be the focus instead of how can government do that, right? How can we as a society invest in the ingenuity within the hospital? And I think that's
why do you think the costs are not decreasing? Certainly all the financial incentive is there. I'm sure those people are just as smart there as they are in dental. What do you sort of see as the root cause?
That's a good question. Honestly, I definitely don't know I definitely don't have the answer, but I mean, I know that when you incorporate the free market into anything, good things tend to come. There's typically more error towards the beginning because you're being more creative and you're just experimenting. Mm-hmm. Then if we're willing to go through that type of process and just not immediately do the emotional appeal and just say, you know what, government should pay for it all. Again, like you said, Mike, I completely see the role in government, and we have to make sure to take care of people and make sure that businesses are not screwing anyone over, for lack of a better term. But at the same time, we need to make sure that there's not so much regulation that the hospital isn't afraid, and when you have so much risk, then, insurance policies tend to increase.
Yeah. Yeah. The other factor is that there's a couple other factors. One is that the way that healthcare insurance companies make money is mind blowing. I don't know if you know this or not, but the way healthcare insurance companies make money is they take a percentage of what employers pay. So if like Google has 10,000 employees in the Bay Area and they contract with Blue Cross Blue Shield, like a big health insurance company in that area, that Blue Cross Blue Shield has contacts with a bunch of doctors and hospitals, and they say, here are your options. And they say, here are your options to an employee. And whatever Google pays, like per patient per month, say it's $150 per patient per month that they're paying, then Blue Cross Blue Shield will take a percentage of that. So the insurance companies are selling to the employers. So they want the employers to pay the most money as possible. The employers don't really have visibility into – employers don't want to pay a lot of money, but they also aren't hugely incentivized to not, because they're withholding money from people. It's not like healthcare or finance direct paying Luke, and then Luke has to go and buy insurance. Because if that were the case, it would be very efficient, like your car insurance. You'd see like, Progressive and automotive and different car insurance companies are like vying for your attention and competing and reducing costs and becoming more efficient. In healthcare, you don't see like health insurance companies marketed to you because they're marketing to employers. So they spend all their time like selling to employers and saying, hey, we have the biggest network in your area. Go with us. There's these local monopolies, and the rates keep going up. The other thing that's kind of crazy is hospitals have no one in a hospital has any incentive to lower costs. In fact, it's the other way around. Yeah. It's like, hospitals just they'll pick out the most expensive thing, and the insurance companies will say, high five. Like, oh, the hospital, the doctor has to pay for, like, get this expensive implant to get, like, pick the more expensive one. And the reason they pick the more expensive one is because the more they bill, the more the health insurance companies make. And employers are in no way or shape or form influential into the healthcare decisions. It's not like a healthcare company, it's not like an employer is going to say, oh no, don't get that procedure. It's too much. Maybe you don't need that leg operation this year. Maybe you can wait next year. Like, those kind of decisions aren't being made at all. So it's a fumbling forward of financial incentives that say, yes, spend more now. And, yeah, that's my rant. I think the one single push I would have is to, if you make one single change, is it's remove the mandatory coupling of employers and health insurance companies. Allow people to opt out. Like, Luke's married to a woman who's also employed at a company who gets healthcare benefits. Like, why would both companies, if you opt out of your health insurance from your employer should be allowed to pay you, and you should be allowed to, like, make an extra 18% per year and then spend that money however you want. But that can't happen. And that's why, like, the efficiency of the elective market is so much higher than it is in the, like, these employer-based models.
Yeah. And I mean, the theme that I hear you stating over and over again is choice. You increase choice, give the decision back to the consumer, the end consumer, and then all the other businesses are going to structure and improve, based around that. But when you take that choice away from the end consumer, then you're without a doubt going to start adding administration layers and things that potentially aren't necessary and actually work against the end consumer.
Mm-hmm. Totally. Yeah. 100%, man. That's there.
I'm sure we could talk about that same philosophy. I'm sure we could apply that to a lot of different discussions, even outside of healthcare.
Well, the one thing about healthcare is it's so fucking big. It's like 18% of our GDP. I think it's on pace to bankrupt us as a country within the next 30 years. It's going to, like, the amount of money that you will pay, and me and everyone around us will pay for healthcare over the lifetime is like, it's like millions. I mean, it's 18%, like, conservatively of what you make. And there's no way, like, think about your annual income, think about 18% of that, and think about how much you actually benefited from the healthcare system. It's not a fair trade, but you can't opt out of that. Like, you can't say, oh, I don't want that. Now, typically the pushback here will be edge cases. It'll be, what about the person who has a, number one, it'll be, what about the person who's very old, has no money, and they need care? Absolutely. Right. We need a way to factor that in. I think people who have no money deserve a social net. So Social Security, Medicare, if they were created to solve that problem specifically, Medicare specifically. But the vast majority of people, like 80+%, should be in a open market just like everyone else. I think it's also, I'm quite sure, although maybe I could be convinced on the mandatory aspect of it. People debate mandatory insurance, just like mandatory car insurance. If you're driving a car on the road, you have to have insurance, with the reason being, if you crash, don't have insurance, then the other person has no way to get compensated that. So it's like inherently, if we all get insurance, then there's decreased risk.
Got it.
I go back and forth on that, because you're opting in to drive a car. You don't have to drive a car. Whereas, like, if you're born, you have to all of a sudden carry this debt to society. But here's why I think it's actually the wise decision to require it, is that if you were to say, I want to be completely free, I don't want to be tied to the grid, I don't want to have to pay this mandatory healthcare insurance. Luke goes and he's playing soccer, smashes his knee. You can't walk, you're in excruciating pain. And we say, well, Luke, you opted out to that. You didn't get that insurance, that mandatory insurance. You didn't get that. So, like, best of luck to you. As a society, the question is, can we morally swallow that? And I think the answer is no. And I think the answer is rightfully no, that we don't want to live in a society where people are being rejected at hospitals. So there's a law, I think it's called the EMTALA law that says if someone shows up to the hospital in need of urgent care, they have to take them regardless of their payment status. So I think that's right. So I think you want to design a system. You have to design the system using the constraints first, and then build the system.
I could agree with that. Absolutely.
Yeah.
But it's definitely difficult. I've never looked through that lens of 18% on average, and did I actually receive the benefit of 18% of my salary this year? And have I received that benefit any year for the past 15 years? And the answer is no, at least for me. I mean, that means I'm lucky. Yeah. But I'm also not lucky because 20% of my income never made it to my pocket. But that's definitely tough. So, I mean, the non-elective space, that's definitely, we've stayed out of it for some specific reasons. I mean, the elective market's just big enough, but it's definitely a whole different ballgame.
Yeah. Well, here's the thing I think is interesting for you is if I'm in your shoes, I'm thinking even within the healthcare market, there are spaces that are elective. So like different types of surgical procedures will be elective. They're not covered by insurance. That can be cosmetic, but it also can be just elective surgery. There's private outpatient clinics that just do outpatient surgery for people. And the number of things that are elective can expand. I think that's the other thing is that it's not static. It's not like, take the overall, the money spent on surgical procedures, take what's currently elective today. Maybe that's 10%. And you'd have to look at the different offices throughout the different states and what payments they collect. But you'd say, how can we grow that pie? Like speaking from your own incentives as a company, you want to grow the number of healthcare facility elective practices that are out there. You want to give the doctors the ability to say, hey, we accept insurance, but we also accept HFD. You could pay this new way. And so I think expanding the elective healthcare space is directly aligned with the growth potential for your company. So I think of it as that's why I was super excited to talk to you, because I feel like this is something I care about. I think it's hugely beneficial to society. And I think if you lean into it as a company to say part of our mission is to expand the potential for healthcare providers to create sustainable practices by offering elective out-of-network payments. And we help facilitate the payment process to make it easy to understand and attainable for the average person. And how I would do it is I would say, okay, what are all the different types of surgical practices and different types of outpatient, out-of-pocket elective procedures going on in healthcare today, and just kind of categorize them maybe by state or by the types of what they do and how much people spend on them, and ask yourself, why can't it be bigger? And my intuition is that it can significantly. And I think payments can be a huge part of what expand the market.
Without a doubt. Do you think that some of these amazing innovations over the last 5 years, like crypto and things like that, are going to actually assist in that endeavor? No,
not crypto. I don't think so. I think crypto's not the right tool for that. Frankly, I think what you're doing is more suitable. We don't need a lightsaber. Crypto's a lightsaber. It's hyper advanced. It's difficult for the average even techie people to understand. It's like a lightsaber in 1940. It's super early, high potential technology. But I think it's we need simple to understand. We need to make it more simple. We need to even now it's too complicated. People bitch about this all the time. They get bills in the mail that they didn't know they were going to get. It's a cliche at this point that health insurance. I think people are more scared to get into an accident and have to pay health insurance costs just because they don't know, or healthcare costs. They don't know what it's going to cost. They don't know when bills are going to keep coming in. So I think simple predictable, straightforward payments in healthcare is like grand slam.
Yeah, especially ones that are approved for every single patient. So there you go.
There you go.
Well, hey, one thing that I did want to throw out there, because I saw this, I heard this from a guy that walked up to me at a trade show. I'm just going to throw the idea that he gave me, and it's just, I don't even know how this would ever work, but it was so interesting that they even thought about it that I thought you'd be interested. So he was saying, hey, what if there was a way for us to utilize one of these new fund vehicles, like an NFT, as a way to actually pay for our treatment? And he literally said, what if you took pictures, like the scan of your mouth, for instance, the x-ray of your mouth was converted to an NFT, and what the funds raised through the NFT is what actually pays for your whatever elective treatment you had. And I was like, I have no idea how that would ever work, but just the fact that you have people out there now thinking through the lens of crypto that I don't even understand yet, and NFTs and the blockchain, they're thinking about ways to utilize those, in every single industry. And we're at the beginning of that, adventure. The best ideas haven't even come out yet, I guess is what I'm trying to say. And I'm not saying that one was the best one, but it's just the fact that there's people thinking about how to utilize it is pretty fun and pretty encouraging.
Yeah. There's definitely a dopamine release when you hear an old problem and it combined with a new technology, and it sparks hope because you're like, oh, we can solve this plaguing problem for society that we haven't been able to with this new technology. I think there's a light side and a dark side to that, right? Like the shadow and
you're going all in on this, the Star Wars.
This is more like psychology. Like there's the people get really excited. They see the upside. And if they get too excited about the upside, then they forget or neglect the realistic downside. And that's what causes ups and downs and depressions and growth cycles. Like we're in a depressionary period right now. It's largely because we got too excited and decided to put aside like basic fundamental. I mean, NFTs are a prime example. Like we're 2 months into a depression, maybe a month into a depression of NFTs, where NFTs are the fastest growing segment of the economy ever in history. Like more money went into NFTs, I think, faster than like anything I could think of in my lifetime. And that happened because people saw them as a solution to just about every problem and as a way to make money. And so it's like, bam, greed kicks in, over optimism kicks in. And you double down on it because you're like, oh, it's the future. And especially when everyone else is doing it, it has this kind of snowball effect. So I think the governor on that you want to deploy is first principles thinking. Specifically, how does this tool, look at it as a tool, not like a savior, is like, what is this tool practically, how does this tool integrate with our system? So NFT is it's a Excel document on everyone's device. Like it's a decentralized database. So it's just a database everywhere. And all the databases check each other to validate how much each of them have in the database, like how many rows and what the values of each wallets are. But the only innovation happening on like layer one, Bitcoin or blockchain rather, is the method for validating the databases. Yeah. So that's what people are building right now. And NFT said, hey, we can do more than just store an address and an amount, like a Bitcoin wallet and an amount. We can store an image and we can track who looks at it and every time it was traded, and we could place a value on top of it. So NFT said, where can we use that? Art. We can use it in art. So people can create art, they can mint an NFT, which basically just means create an address, and then you can move the address. That's what it was. So there's no connection between the actual image and the address. I could download the JPEG, I can print it out, I put it in my wallet. I never own it. So that's I think the separation there between the actual value and what people thought it was going to be was like it increased so widely that there was like a collapse. Whereas like, oh, it's not actually that groundbreaking. So that's the governor I would deploy here. It's like, okay, NFTs for healthcare. You stick it in your mouth and you raise money. What's the first principles mechanism here that makes this uniquely valuable over what we currently have? Do we not have a mechanism for crowdfunding healthcare procedures? If we didn't, like, then yeah, that's cool. But we do, and it's pretty efficient. People trust it. So that's why I'm more skeptical.
Solid point. No, honestly, I'm impressed with the level-headedness because I've definitely seen the same thing to where, and actually for a long time, that's kind of what has made me not an early adopter on a lot of these technologies is just because I know that it's cool, but they immediately think that it solves every single problem, and it's kind of like off-putting in a way. But yeah.
I mean, Bitcoin, just a quick aside on that, solves a real problem in a really meaningful way for billions of people. So I think I'm much more bullish on solving the money problem, because how do we keep track of who creates value? Currently, we do it in the US dollar, but the US dollar is going to be competing heavily, like the US economy is competing heavily with China for the reserve currency.
Yep.
We just kind of like screwed ourselves over by creating trillions of dollars out of thin air and kind of like starting to ruin it.
Who would have thought that that'd cause problems?
Yeah. So I think decentralized, completely trustless mechanism for value accounting is really useful. And that's what Bitcoin offers. Either way,
Good point.
Putting Bitcoin and crypto aside, what you guys are working on is awesome. And Luke, thanks so much for your time today. Do you want to throw out any places where you are tweeting, writing, anything on the personal side? We'll have all the HFD links in the show notes.
Yeah, I mean, we're basically focused on the social, on LinkedIn and Facebook. We typically stay away from Twitter and whatnot.
You are not on Twitter?
I mean, I am, but I like something once a year, and I maybe post one photo on my wife's birthday, and that's about it. Other than that, my head's in the ledger.
Gotcha. Any particular books that you've read that you found inspiring, or people that you found helpful?
Yeah. I mean, for me, Patrick Luchini is one of my favorites. He actually grew up pretty close to Bakersfield, in a little town called Taft. But there's a book he wrote called Getting Naked. And that's definitely, if you have a business that deals with a consultative sell, or, has a longer sales cycle, and it's not, you're not just selling like a standard product over the shelf. Getting Naked was one of the best books that I've ever read. And it's kind of basically just states, you got to just start working with your customer. Don't treat it like a sales cycle. Just start working with them, start delivering value, and then they'll just think of you like part of the team. So that's one. He has a really long list of amazing books that I'd honestly throw on every time you get on a plane and need to pass the time for 2 hours.
That's cool. Patrick Luchini. I've never heard of him. I'll check it out. Cool, man. Well, thanks for hopping on today. Wish you guys best of luck, and keep crushing it.
Thanks, Mike. Appreciate it, man.
All right, baby.